I need to warn you about something that almost nobody is talking about right now. Something that could devastate your portfolio over the next 12 to 18 months if you are not prepared. And I am not being dramatic here. I have been managing money for over 3 decades. I have seen multiple market cycles. I have made billions of dollars by seeing what others miss. And right now, I am seeing warning signs that are eerily similar to periods that preceded some of the worst market corrections in recent history. Let me be very clear from the start. I am not a perma-bear. I am not someone who constantly predicts doom and gloom. In fact, I am fundamentally optimistic about America and about capitalism and about the long-term trajectory of the stock market. But being optimistic does not mean being blind. And right now, there are cracks forming beneath the surface that most investors are completely ignoring because they are too focused on the headlines, too focused on the daily noise, too focused on what worked over the past 2 years. Let me take you back to 2007. I remember sitting in my office at Pershing Square, and everyone around me was celebrating. The market was at all-time highs. Real estate prices were soaring, credit was flowing freely, and most investors thought the good times would last forever. But I was seeing something different. I was looking at the underlying data, the leverage in the system, the deteriorating credit quality, the complacency that had set in across Wall Street, and I started positioning for what I believed was coming. When the financial crisis hit in 2008, most investors were blindsided. They lost 30, 40, 50% of their portfolios. Some lost everything. But those of us who saw the warning signs, who positioned ourselves accordingly, we not only survived, we thrived. We made money while everyone else was losing it, and that experience taught me something that I carry with me to this day. The biggest opportunities in investing come from seeing what others miss, from having the courage to be contrarian when the evidence supports it, from protecting your capital when the risks are elevated, even when everyone else is partying, like there is no tomorrow now. I am not saying we are heading into another 2008. Every crisis is different. The specific catalysts are always unique. But the patterns, the psychology, the warning signs, those tend to repeat themselves with remarkable consistency throughout history. And what I am seeing right now concerns me deeply. Let me walk you through exactly what I am seeing and why I believe most investors are setting themselves up for significant pain. Because if you understand these warning signs, you can protect your portfolio. You can position yourself to not only survive what is coming, but potentially profit from it while others are panicking. The first warning sign is the extreme concentration in the stock market. Right now, the top 7 or 8 stocks in the S&P 500 account for roughly 30% of the entire index. This level of concentration is unprecedented. It is even more extreme than the dot-com bubble of the late 1990s. And history tells us that when markets become this concentrated, when all the gains are driven by a handful of names, corrections tend to be severe. Think about what this means practically if you own an S&P 500 index fund. You are not really diversified. You are making a massive bet on a handful of technology companies. If those companies stumble, if their growth rates disappoint, if their valuations compress, your entire portfolio gets crushed. And right now, those companies are trading at valuations that require near-perfect execution for years to come. I have studied market cycles for 3 decades. I have never seen this level of complacency about concentration risk. Investors have convinced themselves that these companies are immune to competition, immune to regulation, immune to the business cycle. They are not. No company is. And when the narrative shifts, when investors start questioning whether these growth rates can continue, the selling can be violent and sudden. The second warning sign is what I call the great disconnect. Right now, the stock market is priced for perfection. Valuations on many measures are in the top decile of historical readings. The market is acting like we are in a low inflation, low interest rate, high growth environment, but that is not the reality we are facing. Inflation has proven stickier than most people expected. Interest rates are at levels we have not seen in over 15 years. And the economy, while resilient so far, is showing signs of strain beneath the surface. Consumer savings are depleted, credit card delinquencies are rising, corporate defaults are ticking up, and yet the stock market is trading near all-time highs. This disconnect between market pricing and economic reality cannot persist indefinitely. Eventually, something has to give. Either the economy needs to accelerate dramatically to justify these valuations, or the market needs to correct to reflect the actual environment we are in. And given the headwinds I see, I do not believe the economy is about to accelerate. I believe the correction is coming. The third warning sign is the leverage in the system. Private credit has exploded over the past few years. Companies that could not get traditional bank loans have borrowed billions from private lenders at high interest rates. These loans are often opaque. The terms are not disclosed. The risks are hidden from public view, and many of these companies are struggling to service their debt. When interest rates were at zero, these companies could manage. They could refinance, they could extend, they could survive. But now with rates at 5% or higher, the math does not work anymore. These companies are going to start defaulting, and when they do, the losses are going to ripple through the financial system in ways that most people are not anticipating. I have been studying the private credit market carefully. I have been talking to lenders, talking to borrowers, looking at the underlying portfolios. And what I see is deeply concerning. There are billions of dollars in loans that are never going to be repaid at par. There are companies that are effectively insolvent but are being kept alive through creative accounting and extend and pretend strategies. When this unwinds, it is going to be messy. The fourth warning sign is geopolitical risk. I know most investors do not like to think about geopolitics. It feels abstract, it feels unpredictable, it feels like something that cannot be analyzed or quantified. But geopolitical risks have real economic and market consequences. And right now, the geopolitical environment is as dangerous as I have seen in my career. We have ongoing conflict in multiple regions. We have rising tensions between major powers. We have elections coming up that could dramatically reshape policy in ways that markets are not pricing. We have supply chains that remain vulnerable to disruption. We have energy markets that could spike if conflict spreads. The market is acting like none of this matters. The market is acting like geopolitical risk is zero, but it is not zero. It is elevated. And when geopolitical events do move markets, they move them fast and hard. Investors who are not prepared get crushed. Now, let me tell you a story that illustrates how I think about market risks and why being early is so important. Back in early 2020, I was watching the news about a virus spreading in China. Most people were dismissing it. Most people thought it would be contained. Most people thought it was a local problem that would not affect global markets. But I saw something different. I saw the exponential growth in cases. I saw the videos coming out of Wuhan. I saw how quickly this thing was spreading. And I realized that if it reached the United States, if it reached Europe, the economic consequences would be devastating. We would have to shut down large portions of the economy. Consumer spending would collapse. Corporate earnings would evaporate. So I made a decision. I put on a massive hedge against our portfolio. I bought credit protection that would pay off if markets crashed. My partners thought I was being paranoid. Other investors thought I was wasting money on insurance we did not need. But I trusted my analysis. I saw what others were missing. When the market crashed in March of 2020, that hedge generated over $2 billion in profits for our fund. $2 billion in a matter of weeks. And it was not because I was lucky. It was because I saw the risk that others were ignoring, and I had the conviction to act on it. That experience reinforced something I had learned many times before. The biggest risks are the ones that people are not talking about. The biggest opportunities come from seeing what others miss. And right now, I am seeing risks that almost nobody is discussing. Let me lay out the framework for how I am thinking about the market over the next 12 to 18 months, because understanding this framework will help you make better decisions about your own portfolio. First, I believe we are in the late stages of an economic cycle. The economy has been remarkably resilient. Consumer spending has held up. Employment has stayed strong. But late cycle dynamics are starting to emerge. Companies are cutting costs. Layoffs are spreading beyond just technology. Profit margins are under pressure, and the lag effects of higher interest rates are still working through the system. Second, I believe inflation is going to be stickier than the market expects. The Federal Reserve wants inflation at 2%. The market is betting they will get there and then start cutting rates aggressively. But I am not so sure. Wage growth remains elevated, service sector inflation is persistent, and structural factors like deglobalization and the energy transition are going to keep upward pressure on prices for years to come. Third, I believe the Federal Reserve is going to disappoint the market. Investors have priced in a significant amount of rate cuts over the next year or two. They are assuming the Fed will ride to the rescue as soon as the economy weakens. But the Fed is traumatized by the inflation of 2021 and 2022. They are not going to cut rates quickly or aggressively unless we are in a genuine crisis. And that means the market is going to have to adjust its expectations, which typically means lower stock prices. Fourth, I believe we are going to see a significant earnings disappointment in the coming quarters. Corporate America has done an impressive job of maintaining margins despite higher costs. But that cannot continue indefinitely. At some point, companies are going to have to report that growth is slowing, that margins are compressing, that the outlook is less certain than they had hoped. And when that happens, the stocks that are priced for perfection are going to get punished severely. Now, let me be specific about the areas of the market that concern me most. The first area is the mega-cap technology stocks. These are great companies. I am not disputing that. They have incredible competitive advantages. They generate massive cash flows. They dominate their respective markets. But they are priced as if that dominance will continue forever with zero challenges. They are priced as if growth rates will remain elevated indefinitely. They are priced as if valuation does not matter. I have studied enough market history to know that valuation always matters, eventually. Maybe not this quarter, maybe not this year. But eventually, stocks revert to something closer to their intrinsic value. And when mega-cap tech stocks are trading at 30, 40, 50 times earnings, it is a lot of room for compression, even if the businesses continue to perform well. The key insight here is that you can own a great business and still lose money if you pay too much for it. If you bought Microsoft at the peak of the dot-com bubble in 2000, it took you 15 years to break even. Even though Microsoft remained a fantastic business, that whole time valuation matters. The second area that concerns me is commercial real estate. I know I have talked about this before, but the situation is getting worse, not better. Office vacancy rates remain at record highs. Property values have declined 30, 40, 50% from their peaks, and the debt that was used to finance these properties is starting to come due. Over the next 2 years, there is over $1 trillion in commercial real estate debt that needs to be refinanced. Most of it was originated when rates were near zero. Now rates are 5% or higher. The math does not work. Many of these properties are going to default. Many of these loans are going to be written down, and the banks that hold these loans are going to face losses. This is not just a commercial real estate problem. This is a financial system problem. When banks take losses, they pull back on lending. When lending contracts, the economy slows. It is a negative feedback loop that can accelerate quickly once it starts. The third area that concerns me is private equity and private credit. These markets have grown enormously over the past decade. Trillions of dollars have flowed into private investments that are illiquid and opaque, and most of these investments were made when rates were low and valuations were high. Now rates are higher, exit opportunities have dried up, IPO markets are largely closed, strategic buyers are cautious, and the private equity firms are sitting on billions of dollars of investments that they cannot sell at the prices they want. Eventually, they are going to have to mark these investments down. Eventually, the losses are going to be realized, and then it is going to ripple through pension funds and endowments and family offices that are heavily allocated to private investments. The fourth area that concerns me is consumer credit. American consumers have been remarkably resilient. They kept spending even as inflation ate into their purchasing power. But how did they do it? They spent down their savings. They maxed out their credit cards. They took on more debt. The savings that were built up during the pandemic are largely exhausted. Credit card balances are at all-time highs. Credit card delinquencies are rising at the fastest pace since 2009. Auto loan delinquencies are elevated. Buy now, pay later defaults are increasing. The American consumer is stretched, and at some point, the spending is going to slow. When consumer spending slows, corporate earnings decline. When corporate earnings decline, stock prices follow. This is Economics 101. And the data I am seeing suggests that consumer spending is going to slow materially over the next 6 to 12 months. Now, I want to address something that many investors are counting on. They are counting on the Federal Reserve to save them. They are counting on rate cuts to juice the market. They are counting on easy money to bail out their portfolios. I think this is a dangerous assumption. Let me explain why. The Federal Reserve made a historic mistake in 2021 and 2022. They kept rates too low for too long. They dismissed inflation as transitory. They let the genie out of the bottle, and they are still dealing with the consequences. The Fed is not going to repeat that mistake. They are not going to cut rates aggressively unless the economy is in genuine distress. They would rather over-tighten and cause a mild recession than under-tighten and let inflation reignite. That is their bias right now. That is how they are thinking about risk. So when investors tell me that rate cuts are coming and the market is going to rally, I say maybe, but probably not as much as you think, and probably not as soon as you expect. The idea that the Fed will always rescue the market has weakened significantly, and investors who are counting on it may be disappointed. Let me tell you about another time when I saw a correction coming that others missed. In 2015 and early 2016, I was worried about the Chinese economy. I had been studying the data, and I could see that the growth numbers the Chinese government was reporting did not match the underlying reality. Electricity consumption was falling. Rail freight was declining. Steel production was contracting. The numbers did not add up. I put on a position betting that the Chinese yuan would decline. It was a controversial trade. China had massive foreign exchange reserves. The government had a stated policy of maintaining currency stability. Most people thought I was crazy, but I believed the fundamentals would win out eventually. The trade worked. The yuan declined significantly. We made a substantial profit, but more importantly, the Chinese economic weakness that I had identified spilled over into global markets. The S&P 500 fell over 10% in early 2016. Investors who were not prepared got caught off guard. The lesson from that experience is that global interconnections matter. Problems in one part of the world do not stay contained. They spread. They infect other markets. They create contagion. And right now, I see potential sources of contagion that investors are ignoring. China remains a concern. The property market is in crisis. Consumer confidence is at historic lows. Youth unemployment is severe. The government is struggling to stimulate growth. And China is the second largest economy in the world. If China slows dramatically, it affects commodity prices, it affects global trade, it affects corporate earnings for companies with Chinese exposure. Europe is another concern. Germany is in recession. France is struggling with fiscal challenges. The European banking system remains fragile. Energy costs remain elevated compared to the United States. And the continent faces demographic headwinds that will constrain growth for decades. Emerging markets are vulnerable. Many emerging market countries borrowed in dollars when rates were low. Now rates are higher, the dollar is strong, and they are struggling to service their debts. We could see emerging market crises that spread to developed markets. All of these risks are interconnected. All of them could trigger or amplify a market correction, and very few investors are positioned for any of them. Now, let me talk about what I am doing with my own portfolio, because ultimately, that is what matters. It is easy to talk about risks. It is harder to actually position accordingly. First, I have reduced my exposure to overvalued sectors. I am not shorting the mega-cap tech stocks because timing is difficult and the momentum can persist longer than you expect. But I am underweight. I have sold positions that reached my price targets. I have not been adding to names that I think are overvalued. Second, I have been building positions in what I call the unfashionable parts of the market. There are companies trading at 10 or 12 times earnings with strong free cash flow, solid balance sheets, and durable competitive advantages. They are not exciting. They do not make headlines, but they offer value and downside protection. When the market corrects, these stocks tend to hold up better because they are already priced for adversity. Third, I have increased my cash position. I know cash is boring. I know cash feels like you are missing out when the market is going up. But cash is also optionality. Cash is the ability to buy when others are panicking. Cash is protection against drawdowns. Cash lets you sleep at night. In my career, some of my best investments have been made during periods of market distress, when everyone else is selling, when prices are depressed, when fear is rampant. That is when the best opportunities emerge. But you can only capitalize on those opportunities if you have cash available. If you are fully invested when the crash comes, you cannot take advantage. You are just along for the ride down forth. I have been selective about new investments. This is not a market where I want to be aggressive. This is not a market where I want to swing for the fences. This is a market where I want to be patient and disciplined. I want to own high-quality businesses at reasonable prices with catalysts for value creation. I do not want to speculate on momentum or hope. Let me synthesize what I have told you because I want to make sure the key points are clear. We are in a market environment that has significant risks that most investors are ignoring. The concentration in a handful of stocks is unprecedented and dangerous. Valuations are elevated relative to interest rates and economic conditions. The Federal Reserve is unlikely to cut rates as aggressively as the market expects. Consumer strength is fading. Commercial real estate is in crisis. Private markets are facing a reckoning, and geopolitical risks are elevated. This does not mean the market will crash tomorrow. It does not mean you should sell everything and hide in cash. Timing markets is extremely difficult, and you can be early for a long time before you are right. What it does mean is that you should be thoughtful about risk. You should understand what you own and why you own it. You should have a plan for what you will do if the market declines 20 or 30%. Most investors do not have that plan. Most investors are just riding the momentum, assuming the good times will continue, assuming the Fed will rescue them, assuming their portfolio will be fine because it has been fine for the past few years. That is a dangerous mindset. That is how people get wiped out when corrections happen. The best investors I know, the ones who have built real wealth over decades, they all share one characteristic. They respect risk. They do not ignore it. They do not dismiss it. They take it seriously. They prepare for adverse scenarios. They maintain their discipline even when it is uncomfortable. But they give you some practical guidance on what you can do to protect yourself and potentially profit from what is coming. First, audit your portfolio. Look at every position and ask yourself, what is my thesis for owning this? What is the valuation? What are the risks? How much could I lose if things go wrong? If you cannot answer those questions for every position, you probably should not own it. Second, stress test your portfolio. What happens if the market declines 30%? What happens if interest rates stay elevated for another 2 years? What happens if we enter a recession? Can you handle those scenarios financially and emotionally? If not, you probably have too much risk. Third, build some cash reserves. You do not need to go to 100% cash. That is extreme. But having 10 or 15 or 20% in cash gives you flexibility. It reduces your drawdowns. It lets you take advantage of opportunities when they arise. Fourth, focus on quality. In uncertain environments, quality matters. Companies with strong balance sheets, recurring revenue, pricing power, and good management teams tend to outperform when markets are turbulent. They might lag in the speculation phase, but they shine when reality sets in. Fifth, be patient. The correction may not happen for months. It may not happen for a year, but it will happen eventually. Markets are cyclical. Gravity always wins. And when the correction comes, the investors who were patient, who did not chase the last bit of upside, they will be in the best position. I want to leave you with one final thought. The purpose of investing is not to get rich quick. The purpose of investing is to build wealth over time while avoiding catastrophic losses. The investors who succeed over decades are not the ones who swing for the fences. They are the ones who compound consistently while avoiding the big mistakes. Right now, the risk of a big mistake is elevated. The risk of a market correction that wipes out years of gains is real. And most investors are ignoring it because they are focused on the short term, focused on the momentum, focused on what is working right now. Do not be one of those investors. See what others are missing, prepare for what is coming, protect your capital, and when the correction happens, when others are panicking and selling at the bottom, you will be ready to capitalize. That is how fortunes are made in investing. Not by chasing the crowd, but by having the courage and the discipline to see what others miss and act accordingly. The correction is coming. The question is whether you will be prepared. Let me go deeper on something that I think is critically important and that most investors fundamentally misunderstand. It is the concept of margin of safety. This is an idea that goes back to Benjamin Graham, the father of value investing, and it has never been more relevant than it is right now. The margin of safety is essentially the difference between what you pay for an asset and what it is actually worth. The larger the margin of safety, the more room you have for error, the more things can go wrong before you lose money, the more protected you are against the unexpected. Right now, most investors have almost no margin of safety. They are paying prices that require everything to go right. They are buying stocks at valuations that assume perfect execution, sustained growth, benign competition, and favorable market conditions. There is no cushion, there is no buffer. If anything goes wrong, and something always goes wrong eventually, they are going to lose money. I have never in my career made a significant investment without a meaningful margin of safety. I want to buy things at prices where even if my thesis is partially wrong, even if the company does not perform as well as I expect, I still make money or at least preserve my capital. That discipline has protected me through multiple market cycles. Think about it this way. If you buy a stock at 20 times earnings and the earnings decline by 20%, your stock could easily fall 40 or 50%. But if you buy a stock at 10 times earnings and the earnings decline by 20%, your downside is much more limited. The margin of safety protects you. The problem is that finding investments with genuine margin of safety has become increasingly difficult in this market. Almost everything is expensive. Almost everything is priced for optimistic outcomes. The easy money has been made, and yet investors keep buying, keep chasing, keep convincing themselves that this time is different. I want to talk about another concept that I think is crucial right now, and that is the difference between being early and being wrong. Many investors avoid acting on their convictions because they are afraid of being early. They see the risks I am describing. They understand the logic, but they do not act because they worry about missing more upside. Here is what I have learned over 30 years of investing. Being early is uncomfortable, but it is not fatal. Being late is catastrophic. If I reduce risk too early and the market rallies another 10%, I can live with that. I might feel some regret. I might second guess myself. But my capital is protected. I am still in the game. But if I stay fully invested and the market crashes 30%, that is devastating. That sets me back years. That is the kind of loss that is extremely difficult to recover from. And that is why I always err on the side of caution when I see elevated risks. The asymmetry here is important. The upside from being early is that you protect your capital, and you have cash available when opportunities arise. The downside from being late is that you suffer catastrophic losses that take years to recover from. The math clearly favors being early. Let me tell you about another lesson I have learned the hard way. It is about the danger of anchoring. Anchoring is when you fixate on a particular reference point and make decisions based on that anchor rather than current reality. In investing, anchoring often shows up when people refuse to sell a stock because it is down from its highs. They bought it at $100, it is now at $70. They tell themselves they will sell when it gets back to $100. But that anchor, that $100 price, is irrelevant. What matters is what the stock is worth today and what the future prospects are. I see investors anchoring all the time in this market. They bought stocks at certain prices in 2021 or 2022. Those stocks have declined, but instead of objectively assessing whether they should still own those positions, they are anchored to their purchase price. They are waiting to get back to even. And while they wait, they may be missing opportunities elsewhere or exposing themselves to further losses. The remedy for anchoring is to ask yourself a simple question every day. If I did not own this position today, would I buy it at the current price? If the answer is no, you should probably sell. Your purchase price is irrelevant. What matters is the future, not the past. I want to share another perspective on the current market that I think is important. We are in what I would call a narrative-driven market. Stocks are not trading on fundamentals. They are trading on stories. They are trading on narratives about artificial intelligence, about the future of technology, about transformational change. Now, some of these narratives may prove to be true. Artificial intelligence may indeed transform the economy. Some of these companies may indeed generate enormous profits over the coming decades. I am not dismissing the potential. But here's the problem with narrative-driven markets. They tend to overshoot. They tend to extrapolate trends into the infinite future. They tend to ignore near-term fundamentals in favor of long-term stories. And when the narratives shift, when reality intrudes, the corrections are severe. I lived through the dot-com bubble. I remember the narratives. The internet changes everything. Eyeballs matter more than profits. Traditional valuation metrics are obsolete. We are in a new paradigm. Those narratives were not entirely wrong. The internet did change everything. But the stocks that were priced for those narratives still crashed 80 or 90% because the valuations had gotten disconnected from any reasonable estimate of future cash flows. I see similar dynamics today. The narratives around artificial intelligence are compelling. The technology is real. The potential is enormous. But that does not mean every AI-adjacent stock should trade at 50 or 100 times earnings. It does not mean that valuation no longer matters. It does not mean that the stocks cannot decline significantly, even if the underlying thesis proves correct over the long term. Let me talk about something else that concerns me deeply, and that is the complacency I see in the options market, which measures expected volatility in the stock market and then trading at historically low levels. Investors are not hedging. They are not buying protection. They are acting as if the calm will continue indefinitely. But low volatility does not mean low risk. In fact, often the opposite is true. Low volatility can be a sign of complacency, of overconfidence, of investors ignoring risks because they have not materialized recently. And when volatility does spike, it tends to spike violently, and suddenly catching complacent investors off guard. I have found that some of the best times to buy protection are when volatility is low and insurance is cheap. Most people do the opposite. They buy insurance after something bad has happened. When volatility has already spiked and protection is expensive, but that is backwards. You want to buy insurance when it is cheap, when nobody else wants it, when the risks seem distant and abstract. Right now, portfolio insurance is relatively cheap. Hedges are inexpensive, and yet almost nobody is buying them. That tells me that investors are not taking the risk seriously. They are assuming that the benign conditions will continue, and when conditions change, they are going to be exposed. I want to address one more thing before I close, and that is the psychological challenge of investing in uncertain times. It is hard to maintain discipline when the market is going up. It is hard to hold cash when everyone else is making money. It is hard to sell winners when they keep winning. The social pressure to conform, to follow the crowd, to participate in the rally is immense. But great investing requires the discipline to resist that pressure. It requires the ability to think independently, to assess risks objectively, to act on your convictions, even when they are unpopular. It requires emotional fortitude that most people simply do not have. I am not immune to these psychological pressures. I feel them too. When the market rallies and I am underweight, I question myself. When stocks I sold keep going up, I wonder if I made a mistake. But I have learned over decades that my job is not to maximize returns in every market condition. My job is to protect capital and compound wealth over the long term, and that means accepting short-term underperformance in exchange for long-term outperformance. The investors who will do best over the next several years are those who can maintain their discipline through whatever is coming. They will not panic when the market corrects. They will not sell at the bottom. They will not abandon their investment process just because it is uncomfortable. They will stick to their plan, stay patient, and capitalize on the opportunities that emerge from the chaos. That is the mindset I encourage you to adopt. Not fear, but preparation, not panic, but discipline. Not denial, but clear-eyed assessment of the risks. The correction is coming. It may come slowly, or it may come suddenly, but it is coming, and the investors who are prepared will be the ones who prosper. Do not say you were not warned.